down payment and you didn't have the $300,000 to close that deal, you could go raise those funds and that equity from other investors uh, to close the deal. And so the model of syndication is allows you to kind of go bigger and faster, right? It allows you to utilize partnerships and other investors to take down deals where you probably normally wouldn't be able to do yourself. So we love the idea of apartment syndication. We love that model. We're invested in a couple of syndications ourselves, and that's what we've kind of built our business model around. And really, the biggest thing that we like about it again is the economies of scale, right? If you think about it, going back to the example we was alluding to, if maybe you were in the circumstance where you did have the 300,000 and you could put it down, but maybe that's all the capital you had. Well, you could close that one deal, but then you're stuck, right? Then what happens if you want to continue to move on and such? So syndication just allows that opportunity for you to continue to grow a portfolio much faster than you could on your own.
Okay. Sorry to interrupt. If you have if you have any questions, we have a chat box below. Please leave a question, and we'll try to hit that question as soon as we see it. Okay. All right. So Cody, thank you for that explanation. So who are the players in the game then?
I'm sorry?
Who are the players in the game when you say syndication?
So you have two types of partnerships, right? You have the general partners and you have the limited partners, and there's a lot of terms that are used interchangeably for the general partners. You can have the operators, syndicators, whatnot. They're all, generally it all means the same thing. But basically, your general partners are the partnership that is responsible for going out, finding the deal, negotiating the deal, structuring the deal, raising the money from investors, securing the debt, and is getting the deal to close. And then you have the limited partners, who are the passive investors who are, putting their money in the deal in exchange for equitable stake in the deal, but they don't have any operational say so on the property, if you will. They have limited decision making abilities in many cases, and they're just more there for the passive cash flow. So, yeah.
Cool. So when you say general partners, what are their how do they get paid? Are they putting their money in, or what is their pay fee structure?
Yeah. So, every deal's different, and syndicators as operators, you get paid based on mostly fees, right? Fees, and also through potential appreciation. But, anytime that you're investing in a syndication, and this goes for both passive investors as well, is you want to look for operators who are putting in their own money into the deal as well, right? You want them to have some skin in the game. Absolutely. But many times, again, going back to our earlier example, you may not have that capital, right? So you want to partner with people that can help bring that capital to the general partnership, and to be invested in helping to get the deal done. But I got on a ramble there and I forgot where my train of thought was. But anyway, where was I going with that?
So then you were going to then talk about, how they would get paid.
Yes, thank you. That's what I was trying to get to. Yeah. So again, the operators of general partnerships, they get paid on fees, right? So there's an acquisition fee, there's an asset management fee, there's a disposition fee. And in syndication, typically the typical deal structure is such that it's very much favored towards the passive investors. You want, in any of these deals, if you're taking on bigger deals, you need the passive investors to get these deals done. So you want to make sure that you're putting their interests first. So in general, most syndications, you'll find that the equity split is very heavily favored to the passive investors. So as syndicators, you don't get as much of the cash flow in many cases, or you don't get as much as the equity up front. But if you're in a value add play, for example, and you're going in and forcing the appreciation over the life of the investment, then you can, then you may be able to capture that appreciation on the back end. But most of the compensation for the syndication is through fees.
I see.
Yeah. So and I see a couple questions coming in. So let's see. those fees a percentage of the deal total? How are those fees calculated? So yeah, so every operator in every general partnership will have a different fee structure. You know, typically I would say for an acquisition fee, 1 to 3% is probably pretty typical. Asset management fee, again, you know, 1 to 2%. Disposition fees, I haven't seen a whole lot of disposition fees in a lot of the deals that I've looked at, but you know, but basically it's up to the syndication team or the general partnership, excuse me, on how they want to do that deal structure. And yes, it's usually based on, in the case of acquisition fee, it's based on the acquisition price, right? Asset management fee will be based off the general income that's coming in from the property.
Code. I'm going to stop you for a second.
Mm-hmm.
Acquisition fee. We're going to go through the three of them. So acquisition fee means blank, and let's give a quick example, like $1 million purchase.
Yeah. So again, so an acquisition fee is a fee that the operators get for being able to close the deal, to put the team together, to get the deal to contract, right? And again, if in your case of $1 million, if I say I'm going to put a 1% acquisition fee, then I would get that $10,000 acquisition fee for putting the deal together, right? And go ahead. You look like you had a question.
Yeah. Okay, so now what happens to that $10,000, the 1%? Do you have options with it, and do you know how it's taxed?
So do you have options with it? Meaning,
for example, I'm trying to allude to, some people tend to put it right into the deal. Is that a possibility?
Yeah, some people have done that. You'll find this. Some general partners may incorporate their acquisition fee into the deal. I've seen that a variety of different ways. The general partners can take that acquisition fee and really decide what they want to do, if they wanted to invest it back in the deal or not. But how it's taxed, that is a very good question, and I don't know the answer to that, but I would refer that back to your CPA or your syndication, your real estate CPA, to kind of help answer that question. I don't know. That's a good question.
Let's hit the what's the asset management fee?
Yeah, so the asset management fee is the fee that the sponsorship team gets for managing the asset, right? Making sure the business plan is executed, making sure that investors' returns are getting paid out, and just making sure that the deal is getting executed according to the overall business plan. And so usually, again, I've seen asset management fees typically around 1 to 3%, and that's based again on the general revenue that's coming in from the property. So if it's 1% and you're yielding $100,000 a year, then you're going to get $1,000 in cash flow from the asset management fee. So yeah, and then the last. Oh, go ahead, Joseph.
No. I was going to touch upon the last third one.
Yeah, so the disposition fee. So you in these deal structures, you have what's called waterfalls, which is basically an assignment of how distributions are paid out in order of priority, right? So if anytime that the deal is refinanced, or if the deal is traded or sold, that's considered disposition. Then the general partnerships may have a disposition fee in there, usually again 1% of whatever that refinance is, or the trade price is. So again, I haven't seen too many disposition fees in the deals that we've seen or we've been invested in, but that is something to be aware of. So, and if there's anybody that's interested in passively investing, I would definitely encourage you to make sure that when you're working with your sponsorship teams, make sure that you're looking at the fee structure very closely. You do not want to be, or you want to be cautious of deals or general partnerships that are very heavily on the fees. If you got an acquisition fee of 5% and an asset management fee of 3% and disposition fee or whatever, then you really want to be cautious of that, and you really want to dig into why they're trying to to slap on those type of aggressive fees. Now, and granted, you want your syndicator, you want your operators to be motivated, right? You want them to be compensated for their work. And if you haven't gone through this process before, you know, I can share an experience. I was in a general partnership last year on a deal. It was a lot of work to getting these deals from start to close. All right. And then the work becomes even more when it comes to the asset management side. And so you want your general partnership to be compensated for the work, because you want them to stay motivated, right? At the end of the day, you want to make sure that they're out there driving the business plan to make sure that you as the investor are getting your returns. And they're fiduciaries of your money, right? So you want them to be protecting your money. But anyway, that's just some tidbits about, what to look for.
Okay, so the acquisition fee in the beginning, that's one time, right? Asset
Yes.
management fee is like you charge them monthly,
Ongoing.
ongoing, and when you exit, the disposition fee, some people may charge, some people may not, but that's also one-time fee, right?
Correct.
Okay.
Yeah.
I'm going to hit you with the question code. If I see there's a bunch of questions in there, so I'll try to make this quick.
Go ahead.
Would you prefer, Cody? Let's say you're a limited partner, you're a passive investor. Would you prefer to see a deal that's got a 3% acquisition fee, or a 1-1-1 where it's 1% acquisition, 1% asset management, 1% disposition?
That's a great question. I think that's a question that probably have to dive in a little deeper, right? I mean, I think it's going to depend on the sponsorship team that we're investing in and the track record, the type of deals that we're in. But, I don't think the first part of that example, a 3% acquisition fee, I don't think that's overly aggressive. But, if it were maybe a first-time syndicator or first-time GP group and without a track record, and they were, slapping on that type of acquisition fee, I would probably be like, I'd probably question a little bit. But typically, again, I don't believe in being very fee heavy. So I like the idea of, a 1 to 2% acquisition fee, maybe a 1.5% asset management fee. And, again, I disclose, I'm not very big on the disposition fee, but a 1-1-1 structure, I would probably tend to lean more towards myself. So.
Yeah, because in reality, there's also that the GP will get paid if the property performs well when the waterfall begins to hit, so after the preferred return. So there's another way to get paid too, and you want them to push that.
Right.
Yeah. Right.
What do you call it? A hurdle?
Yeah, the hurdle. Right?
Yeah.
You don't want to just you don't want them taking those fees and running. You want them working on the property, right?
Yeah, absolutely. No, absolutely.
Okay. I'll read another question. Do the investors, from James, do the investors you've worked with consider the fact that you, as the GP, are putting your name on the bank financing and skin in the game if you don't have a lot of liquidity to start?
Read that one more time.
Sure. Do the investors you've worked with consider the fact that you, as the GP, are putting your name on the bank financing as skin in the game if you don't have a lot of liquidity to start?
Yeah, so I think it's a considerable factor. I mean, when you're going out and you're putting your name on these loans, I mean, especially when you're looking at multi-million-dollar loans, even though there's, most people are out there for the golden goose, the non-recourse debt. Well, you have to really dive into that, because not every deal or every non-recourse debt is fully non-recourse, right? When things hit the fan, I mean, there are some things that you have to be aware of where they can come after you. So my point to that is, if I'm putting my name on a $5 million loan, for example, that should have some weight and some credibility, because I'm putting my name, my credit, my assets at risk by doing that. But, there's the advantage of having a group or a syndication, or excuse me, I keep saying syndication, a general partnership, is that, you can disseminate a lot of that amongst different groups, right? So typically you may have a sponsor that comes in and they're the ones that are signing on the loan. They have that net worth equal to the loan amount. And you may have a partner that's delegated just to that, and then the rest of the people are bringing the money to the table or whatnot. But To go back to the original question, I do feel like that should carry some weight, but I also think that, you have to look at the whole partnership as a whole. And if they have the liquidity to be investing in the deal, they should be investing in the deal.
Okay. And so let's say you find a nice property. You think it's going to be, projection wise, you think it's going to be profitable to bring investors in. How do you find these limited partners?
So that is a great question. And here's this is probably, in my opinion, one of the most challenging and most important skill sets you need in this business if you want to scale and you want to pursue syndication, right? Is the ability to raise money from passive investors. And building those relationships is number one. Ultimately, people are going to invest in people who they like and trust, right? You can have a fantastic deal, but if they don't like you, they don't know you, or they don't trust you, you're not getting their money, right? Nor should they. So, you really have to nurture the relationships with people that you want to be passive investors with you. And so through your networking comes a lot of those relationships, right? Things like this, meetups, local networking events, just people within your close network, family and friends. Although I find that in my experience, I don't know that that's always the best resource, because I'm a big follower of Hunter Thompson, and he relates this to his book, and your friends and your family, they're the ones that have seen you drunk on 4th of July, hanging out at the beach, doing stuff you shouldn't be doing. So, that's how they're always going to remember you. But anyway, you want to really go out and you really want to build an investor database that you can nurture and build those relationships with. So how do you do that? And this is something that I learned the hard way in my experience last year in the general partnership. Is number one, you want to identify who your target investor is, right? It's easy in the beginning to go out and start raising money, and you're really talking to anybody and everybody. That's great, but you may find it hard to kind of gain traction, right? Not everybody may be investing in real estate. Maybe this is their first exposure to real estate, or, you may have people that are invested in only a certain asset type or things like that. So you really want to identify who your investor database is, your ideal avatar, if you will. You hear that a lot. Maybe you're targeting accredited investors only, or sophisticated investors, which we'll talk about here in a minute. Again, you just want to figure out who that is, right? Mm-hmm. Then you want to identify what is their interest. Okay. Again, where are they looking to invest? What's their risk tolerance? You have some people that have more appetite for risk. Maybe they're willing to take on, more of a risky deal in exchange for more equity in the deal, or maybe a potential for higher return. You have people that may be looking for more of a core play, more core of an asset, so the stable cash flow with a lower return. And then you want to really build credibility. And so how do you do that? After you've identified those things, how do you build that credibility? So you want to be able to educate, you want to be able to add value, and you want to be able to tell your story as to what you're doing, right? So you want to be able to share it as what your business model is and how you plan on pursuing that business model. You want to be transparent with your team, and then who are you working with, and then you want to have multiple touch points. And this is important. And this is, again, something that I learned the hard way, is just because you build an investor database of people that you've shaken hands with, or you've met a couple times, but that's really the extent. That doesn't necessarily mean that they're going to want to invest with you. So you want to have ongoing touch points and constant communication with them. So one thing that we found to be very effective in nurturing those relationships is a number one, a newsletter. So we send out a monthly newsletter to our entire investor database that kind of talks about just things that are relevant to the market, what's going on, especially in the target markets that we're in. And then a little bit about John and I. We're both dads, and so we like to share a little bit of our family story sometimes on there. And then just some things in our alluding to, like our meetup and our podcast and such. The next thing, again, you want to do is a virtual meetup, or meetup in person, whatever it is, but just having a live face-to-face conversation with people, constantly get in front of them, constantly networking with them in that way, in that fashion. And then for us, the podcast has been an amazing benefit to us, because not only are we having conversations with people either in person or by phone, more so that here now during the COVID pandemic, but they're also seeing our newsletter, they're getting updates on what we're doing, and they're hearing us. They're hearing what we're doing. They're hearing our story and our message through our podcast. So having multiple touch points and just providing value and education is a great way to build that credibility and that trust and that ongoing relationship with them as your investor. So if you're out there raising money and you want to, that's definitely some things that I would definitely recommend.
Okay. Well, I have one more question, and then probably Nico, you could probably read the questions in the chat box, please. My next question is, so sending out newsletters, like how to nurture, that's good. I'm really glad about that information, but that's, I think, more of so from the GP's point of view, but let's say if there's LP out there, let's say this is my first time seeing you today. I listened to your story. I think you're great. I think you're very, you have a good property. So I have, let's say $50,000 or $100,000. I want to do something with you. But this is my first time seeing you. Can I just give you my money?
No, not legally anyway.
So what is there the legal barrier that you have to?
Yeah, so that's a great segue into the legal aspect of raising money. And again, one caveat here is anything that we're discussing today, make sure that you're consulting your legal counsel, make sure that you're consulting your professionals. Okay. But basically the SEC commission has very strict laws on how we raise money for real estate. Right. And so when you look at what is defined as a security is anytime that an investor is investing capital in exchange for an equitable stake or share for a return, that's considered a security. So by definition, you would have to report or submit your business to the SEC commission, right? Well, that's very, very expensive, very, very costly. And, it just doesn't make very much business sense for most of us as small business owners, right? So, but luckily the SEC has afforded us two exemptions, the 506B and the 506C exemption, okay? So you have two definitions of the type of investors. You have a sophisticated investor and you have an accredited investor. So a sophisticated investor is somebody who has the mental wherewithal to make a business decision, but has a net worth that's less than $200,000. Jamie, I see your cat in the background. It's all good. It's all good. I'm surprised you haven't heard my kids in the background tearing up the place. So
the cat's trying to listen to the syndications.
Hey, nobody judges who has business partners or what they are, so it's all good. But no, anyway. So again, your sophisticated investor, net worth less than $200,000, but again has business sense. They can they can make good business decisions. So to answer your question, maybe in your example, this is a person I'm meeting for the first time today, and they've never invested in real estate before. They've never done anything at all, and they just want to hand me a $50,000 check. I would not consider that a sophisticated investor. Okay, they're not aware of the risk. They're not aware of the potential pitfalls in investing in real estate, and so we have an obligation to make sure that we're educating them, and before we take any money from those people. So then you have your accredited investors, right? Those are people that have a net worth, a net worth of $1 million, not including their personal residence. They have an earned income of $200,000 if they're single for the past 2 years, and expected to have the same in the next year, or they have a combined household median income of $300,000. So when you look at the regulations, when you look at 506B, you're appealing to both sophisticated and accredited investors. And we can dive into that a little bit more, but with the 506C regulation, you're soliciting to accredited investors only, right? Now, the difference is how we conduct our business. So when we're going out there and raising capital, if you're pursuing a 506B and you're you're trying to attract sophisticated investors, you have to have what the SEC considers a substantive relationship, right? You have to have an ongoing relationship with them before you can accept any of their money. And now there's some gray areas, and how that's defined is, there's probably a little bit of subjectiveness to that. But basically, you want to make sure that you're having an ongoing relationship. So you have a conversation with them, you identify who they are, what their interests are, and then what their knowledge level of investing in real estate is. And then you want to, again, to continue to build on that relationship. And it's recommended. I've heard this, a couple of times, but there's this unsaid rule. Maybe you wait 30 days from the first interaction to you actually take any of their money. I don't stick to that. I just consider if I'm meeting you for the first time and there's a connection here and there's a potential, for us, it's just further down the road, right? Well, I want to make sure that I really get to know you, understand you, your background, what your interests are. And that means multiple conversations over the course of however long that takes. So there's really no real defined guidelines from the SEC on what makes up a substantive relationship. But you want to make sure that you're taking your time building that relationship, and you want to make sure that you're documenting that as well. This is very highly recommended. You're documenting those conversations, and you want to make sure that they're intentful. It's not just hey, how's the weather over there in San Fran, and then, that's it. You really want to make sure that you're being intentful in the relationship. So, with the SEC, again, going back to the solicitation with a 506B, I can't go out and market my deals. So I can't go to Facebook, and I can't go to social media, and I can't just blast out, hey, I've got a 100-unit deal under contract. Who wants to invest with me? You cannot do that. That is illegal. Now, if I have a 506C and I'm pursuing accredited investors only, the SEC does allow you to solicit, because in general, the SEC looks at accredited investors as those who have the means to protect themselves if, in the case an investment were to go south. They would have the ability to recover faster, and they have the business sense and the business savviness, to make a very informed decision. So, and we just actually covered this in our meetup last week, and the way our attorney had described it is, typically your accredited investors would already have professional advisors in place to kind of help them source certain opportunities to make that decision. So in that case, you can go out and you can solicit to them. So again, I go back to my social media example, where if I wanted to solicit to accredited investors only, I can go on Facebook and I could solicit that deal, but I can only take monies from accredited investors. And that's very important. Make sure you don't get caught up in that. And so the way that you do that, obviously, is you would go through a third-party verification, make sure that, the investor is who they say they are, and they can prove that they are truly an accredited investor. And you definitely want to make sure you do that before you start accepting funds. And of course, you want to go through your SEC attorney, make sure that you're drafting your private placement memorandum before you take any money whatsoever. You want to make sure that that's in place before doing that.
All right, great. Thank you. There was a well put general ideas of 506B and 506C. Thank you. All right, Nico, do we have any questions?
We got a lot of questions. I tell you, this is a group that is very interested in this stuff, because so Cody's throwing out terminology like lawyer talk, and if these people are able to still ask questions and pay attention, forget about it. They're sold. Let's do it. Let's do business together, guys. This is great. We got a good team.
Yeah, I love this group. Let's go.
Yeah, we answered a lot of these questions, so I'll kind of try to fly through them. But Shane's asking, so we did that first part. How did you navigate the SEC regular? I guess we're good with that now. But you did mention that you have an SEC attorney. So do you have a real estate lawyer who knows this stuff well? Would you maybe be willing to share that contact with us?
Oh yeah, no, absolutely. One guy that's local here that we really like, Melvin Farabee. If remind me, I'll put in the show notes later, or the chat box, but I'll link our meetup video from last week if you want to go back and watch it, and I'll send over the contact information. But check him out. He's based here in Houston. He's really good. I've worked with Mauricio Raould. If you're on Facebook and if you're in in or near California. He's based out of California, and very prominent SEC attorney as well. And yeah, I would definitely recommend those two to start. So.
Okay, so we're gonna backtrack for a second and then jump to the SCC questions again because people love that stuff. But so back to the disposition fee. How come you're not so big on the disposition fee? This is the second person that Luis has heard said that they kind of would rather not either charge a disposition fee or have noticed that people don't necessarily like. Why avoid the disposition fee over the acquisition or asset management fee?
Yeah, I mean, I just for me personally, again, I just don't like the idea of being fee heavy. You know, if I'm going to do an acquisition fee and an asset management fee, I don't need to tack on a third fee. I mean, granted, I mean, we want to, you know, we definitely want to be compensated for the work that you're doing again. And there is a motivation there to, if I can refi out and get your money back sooner than later, obviously that's the goal. And that's one of the reasons for the disposition fee, right? If I can meet a projected return for you in, you know, 2 years, for example, and I can get you, you know, 70% of your capital back and, you know, earn a fee off that. I mean, yeah, I can see why people want to do that. I just, again, I'm just not so big on fees. You know, for me, I would rather keep the investor interest first and let them have more of the capital. And that's just our approach. That's just what I like to do.
Right. Let's go for it, Yos.
Oh, I think if you forego with that, I think investors may be more, you know, they are more likely to come back with for the next your next deals maybe.
Yeah. I mean, listen, I mean, look, if you're a Rod Khleif or you're, you know, the Jake and Genos of the world or whoever, you know, Michael Becker done 12,000 units. I mean, if he came up to you and he said, hey, look, I'm gonna do a 5% acquisition fee and blah, blah, blah. Am I going to question it? Probably not, you know, just because of the track record speaks for itself. But as a newer syndicator, somebody who's trying to build that track record and that trust, you know, you have to be conscientious of that and understand that, you know, you have to prove that you can work the deal and you can execute the business plan before you go start slapping all these fees on there. So, you know, just be cognizant of your position and you know, your track record. And, you know, again, in keeping the investor interest first, I would recommend, you know, obviously, again, you want to be compensated, but just be wary of the fee structure.
Right. It might be an ideal time for you to sell so you can get that fee, but it might not make sense overall for the investors. So you're right. You got to make sure that for, you know, that the best interest in mind is of the investors.
That's exactly right.
Rachel's saying more about the SEC. So we've answered the majority of this, but there's a little part that we can talk about. So are you working with SEC experienced lawyer for a private placement? And I think it would be most important to advertise. So she's looking, so which one can you advertise? Let's, I guess, review which one can you advertise? And is it always, I guess, is there pluses and minuses to advertising your...
Yeah, so 506C, the accredited investor, that's the one that you can go out and solicit. That's the one that you can go out and advertise. You know, the benefit, I guess, of doing that is I can go out and I can market freely and not have to worry about running into SEC trouble, right? I can, as long as I'm taking only accredited investors, that's the most important thing. But there's the idea of, oh, if I can go on Facebook and I can get 10,000 likes or 10,000 views on my deal, I'm going to attract a certain amount of accredited investors or through networking events. You know, if you're networking with you know, a group of high net worth individuals, all accredited investors, and you know, you want to go solicit your deal to them and you never shook hands with them, you know, you can absolutely do that. But the reality is for me personally, is the pool of accredited investors out there, it makes up really a fraction of the investor pool as a whole, I guess at our level, really, you know. And so you got to think a lot of people are competing for that same money. So if you're going out there and you're trying to recruit for only accredited investors, and by the way, you have no track record, you're putting yourself at a pretty steep disadvantage. And, you know, and that's one thing to be mindful of. And, you know, we saw this in, again, my experience last year in our GP deal where we were doing a 506B, as much as we would love the idea to have only accredited investors, we understood that, listen, accredited investors, they're very savvy, and sophisticated investors are very savvy as well, don't get me wrong. But, when you're dealing with these high net worth individuals, you better have a track record or a team assembled that has a track record that can, prove that you're going to be a good fiduciary of their money. And that rings true with any investors that you're raising money from. But I think it just puts you at a steep disadvantage when you're just starting out to just try to target accredited investors. And I was speaking to an operator last year who had done, I think he had done like 300 or 400 units on the GP side. And he was soliciting a deal as a 506c. And when I was talking with him, he was like, in hindsight, I would go back, do this deal over. I would do a 506b because it's believe it or not, it's a little bit more challenging. I mean, how many people do you know in your network that maybe not meet that accredited investor criteria, but they may be willing to invest if you were doing a 506b? Maybe they had the 50K to invest, but because they weren't an accredited investor, they couldn't invest in your deal. So personally, I like the 506b model. Now, the thing that you have to be aware of when you're raising money is you have a limited amount of sophisticated investors which you can put into the deal. So it's 35, and then you can have however many accredited investors after that. But so if you're doing a large raise, and this is another thing to consider as well, if you're taking down a larger deal and you have a much larger raise, that will definitely impact your ability to raise money in a 506b. So that's something to consider as well. You may have to have a higher minimum, or maybe you do have to go to accredited only. So just some things to think about when you're going through the process.
Thank you. We have a lot of questions. Let me touch this. Lewis, how can you judge that a person can make good business decision? And Craig actually left a good answer. If they are eager to write a check without conducting any due diligence on the deal, then they're not making good business decision.
Yeah, and look, let me tell you guys too, as a operator and a syndicator on the GP side, especially when you're first starting out and you're trying to really gain momentum, it's very easy to get into the lure of wanting to take money from anybody that's willing to invest with you. But be smart, okay? You have to be disciplined and make sure that you are being privy to that, because let's say, for example, you have that somebody who's just so eager that they love what you're doing and they just want to write you this $50,000 check, and they give you the check and you invest in your deal, and then the deal goes south or something happens in their life and that was the very last $50,000 they had. Well, you just put them in a dire situation, and so you as an investor taking other people's money, you have an obligation to that investor, not only to their money, but just to make sure that you're being good stewards, right? So you want to make sure that you're not getting in the lure of just anybody and everybody that comes up to you and wants to write you a check. You really want to make sure that you're vetting who it is that you're working with as well, and not every investor is going to be a good fit for you. And this is something we learned too. If you've got that investor who's blowing your phone up every 5 minutes, questioning everything about this or that, or they're challenging everything you're doing, not necessarily that it's a bad thing, but that's you're in this for 5 years, 3, 5, 7 years, sometimes 10 years, depending on what the strategy is. So you want to make sure that the investor is in line with your interests as well. So it is twofold. You want to make sure that you're building an investor database that is in line with what you're trying to do. So,
Cody, I'm gonna just touch upon some of the comments here. Okay, Rachel said if you have any, I think it's what she meant is if you have any ongoing deals. Do you have any ongoing deals that you're trying to present to LPs or business plans? Or
I'm sorry, can you say it again?
Do you have any projects that you're trying to present to LPs?
Do we have any deals?
Yeah, right now.
No, right now, unfortunately not, man. I mean, just for us, deal flow has been very stagnant given the COVID pandemic. So we're in Houston, Texas, and we're looking here in Houston and San Antonio. And, we've, in our opinion, Houston and San Antonio, Texas in general, has been very bullish like most of the other, primary markets across the country. And even last year prior to COVID, I mean, valuations just really wasn't making a whole lot of sense for us. So we were having trouble finding deals that we felt were um, that met our criteria or that really penciled out. And so, and then of course now we have the COVID pandemic. So most of our deal sourcing is coming through brokers. And what we've seen in our respective markets is just that deals have just either the sellers have either pulled their deals off the market or they're just continuing to hold on to the valuations they had pre-COVID. So unfortunately, we don't, but we're actively sourcing. So,
Okay, good. James' question: investor relationship. Can that be between anyone as long as it's within the general partnership realm?
can it be within anybody? Within?
Yeah, like there's no need for pre-existing relationships between general partners. I think that's what this question is.
So like on the general partnership side, can you invest with anyone? Is that the thing?
Yeah.
Yeah. So, yeah, the thing there is you still want to have a relationship. Again, this is like a marriage. You're in this deal for, 3, 5, 7, 10 years, however long. And you want to make sure that, especially on the general partnership side, that you have a very strong relationship with whoever it is that you're working with. Are these people credible? Are they people that have good integrity, alignment of interest? Do they have, certain skill sets that you need that can be applicable to your general partnership? But you definitely want to make sure that you're partnering with people that you can trust and that that you feel comfortable working with. So I would definitely encourage you. I mean, it goes both ways. I mean, this is a relationship business. With anything we do, guys, it's all about the relationships, and you really want to make sure that you're partnering with the right people in these deals for sure.
I think, and also James, I think it's asking, like, if you're trying to get an investor, can that relationship be with any one of your team members? It doesn't have to be with every single team member on the GP side.
Yeah. So there are situations where you can, let's say, me and Nico are partnering up and I'm doing the deal acquisition and Nico's doing the equity raise. Your investors have to have a relationship with somebody within the general partnership. Yes. They do have to have that relationship. Where you have to be very careful with as a general partnership is if you're hiring somebody to help raise equity for you for a fee. You can get into some very hot water if you're doing that. So, and there's sometimes a lot of people out there doing that say, hey, I'll raise equity and I'll take this fee for it. That is illegal unless they are a licensed broker to do so. So just don't get caught up in that trap. But yeah, make sure that whoever it is that's on the general sponsorship team that is responsible for raising equity, whether it be one or all, they have to have that relationship with you. Yes.
Cool. Looks like we're being fired up with all the questions. However, we have, yeah, I know. Nico, you want to maybe have one more question, and we're trying to wrap up here.
Okay, let's see.
We're just getting started. Come on now.
You got your water with you? You get your throat lozenger? I mean, all right. So, okay. So James, again, if you start a syndication as a 506C, are you committed to that, to remaining as a 506C for the duration of that raise? Or
yes.
Can you switch? Okay.
Yes. Yeah. You would have to go back and redraft all those documents and restructure the deal before. So, but yeah, you're committed. So.
Okay. So here, go for it.
Probably touch the one last one Craig just posted. What is your perspective on the potential impact of COVID-19 on multifamily investing, both short and long term, and has it changed your strategy?
Yeah. Hey, great question. Great question. This is a question that's going around with everybody, right? I mean, everybody has an opinion on this. Listen, man.
Now we're just opening another hour of discussion here.
Well, no, I mean, look, guys. I mean, this whole conversation. Listen, I'm not an expert. There's so many people that are experts in that field and that can make a better assessment of that than I can. I think that I would leave those assumptions to those professionals. But here's my outlook. I think that we're going to continue to see cap rate compression. I think that the investor appetite for multifamily as an investment vehicle has become so much more in the past couple of years. And I think as we ride out this storm through COVID, I do feel like in multifamily is going to prove again that yet it is a very resilient asset class. Will there be some pain? Absolutely. I do feel that way. But I do feel like most people in the multifamily space are going to come out okay. And I think that's only going to further fuel, that investor appetite. You take that in addition to, debt being so cheap right now. I mean, the Feds have, I think committed to keeping rates at like 0 right now, which means that you're going to be able to get debt for, stupid cheap for the next, year or two. And then you have, what is it? $3 trillion of just equity, just sitting on the sideline waiting to be deployed. And so, and they're, again, that investor appetite, people are looking for these hard assets. So I think that we're going to continue to see cap rate compression. I don't think that we're going to see a major drop in valuations. And I think it's going to be challenging. Listen, I'll be honest. I think for us as newer investors, it's going to be harder and harder for us to get a leg up in this space. It's just, unfortunately, it's the way it is, man. It's stacked against the little guy. But in hindsight, all we can do is continue to plug away. I think relationships are huge. Partnerships are huge, especially for those who have a track record and who have experience. Network with those people, get in with those guys and build relationships, add value to them, and definitely try to partner. And just never give up. I mean, that's the biggest thing, is you got to keep plugging away. I mean, all these big time investors you see, they all started from somewhere. They all started with 0, right? And so, but going back to the original question again, I think that we're going to continue to see, cap rate compression, and valuations are still going to be inflated. So now, how does that change our strategy? I don't know that it changes our strategy very much. I mean, we're still focused on a very specific investment or asset type. And, we have very specific investor criteria as far as return profile that we're looking for. And so we're still going to continue to underwrite for that. And I mean, it's a numbers game. The more that you're evaluating deals, the more that you're underwriting deals, and the more that you're submitting LOIs, eventually something comes along. So, we're just going to keep plugging away, and, hopefully the wind will be in our backs.
Great. Thank you. How do people reach out to you if they have a question?
Yeah, definitely check me out on social media. I'm very, very active on social media. You can check me out on Facebook and LinkedIn at Cody Laughlin. You can follow us on Instagram. I refer everybody on the Instagram to the Blue Oak Capital page preferably, but check out my email address as well, cody@blueoakinvest.com. Man, give me a call, 337-794-8283. Would love to chat. I can talk about real estate all day. So.
Okay. We'll leave his information in the checkbox for everyone who wants to reach out to him.
Yeah. So.
Nico, your mic. I think you're trying to say something.
Yeah. 337-794.
8283.
8283.
Yeah.
All right.
And I am Central Standard Time. So wherever you're at in the country, just don't blow me up at 2:00 in the morning.
All right. Great. All right. So we're trying to wrap up here. It's been a lot of questions. And I think if we wanted to, we could have gone another hour, but we're going to stop here. Thank you very much, Cody, for your being our guest today. It was very informative.
Yeah, guys. Hey, thank y'all, man. It's been a pleasure. I love what you guys are doing. Love always networking and speaking with you guys, and to everybody in the group. It's very nice to meet you. I hope, hopefully, I was able to share something that you found of interest, or some little nuggets here and there. But hopefully we'll all be at the top here soon.
Great.
Make it happen.
Thank you. Make it happen. Nico, who do we have next for our next meetup?
Yep. All right, so next meetup is going to be an awesome topic as well. Next meetup, we are going to be talking about seller financing. We have Larry Fierro, who went from being in debt to owning 10 properties that he acquired all through seller financing and became financially free. He's currently financially free, and he's working right now on an 18-unit deal, seller finance again.
Nice.
He just did a presentation for the Multifamily Investor Nation Summit. So he is going to present that same presentation that he did for Dan Hanford's people to us.
All
That's
right,
awesome.
great. Can't wait to listen to his story. All right, guys, thank you very much again for coming to Nico and Yosef's mini. What is mini, Nico, by the way?
Mini multifamily investor network, New York, or Nico and Yosef.
Yeah, I like that. I like that. All right. Thank you very much, guys,
Thank
again.
you.
Thanks, guys.
We'll see you again, okay? Thank you.
Take care,
Thank you.
guys. Awesome, guys, man. That was a lot of fun, man. Appreciate it.
Yeah, thank you, Cody. I mean, like, you're like firing people, questioning.
Sick, man.
No, man. I don't know what it is. Sometimes I can stumble in my words a little bit, and I hate that. But hopefully people got a lot of value out of that. And
Oh, yes,
hopefully,
I'm sure. A lot
Yeah.
of golden nuggets.
hopefully I didn't steer anybody down the wrong path there. So
No,
Man,
no. Definitely
That was
not.
awesome. You got a lot of good information there. I guess we'll get the attorneys from you too, and we'll put this in the. I could just put it in the chat box right now because I'm going to send that out to everybody.
yeah, I tell you what, let me pull that up for you right now.
So Cody, Rachel is one of my attorney friends. She's an immigration attorney, right? Who's been posting some questions. I didn't really read some of her comments because to save the time, but actually she suggests me to look into this. This is so I don't know if you know, there's some foreign national visa called E2. It's like an investment visa, but have you heard of EB5?
I haven't heard of EB5.
EB5 is same as an investment visa, but the American government will